JJ the CPA here. Hope you're doing well. I want to give you an important update related to the Build Back Better bill, HR 5376. The first thing to note is that this is putting us in quite a quandary for year-end tax planning because it has passed the House, not yet the Senate. The Senate has come back with a draft indicating what they agree and don't agree with in terms of what already has passed the House. Word is it is not going to pass before the end of the year. Through the Senate, it would not become law. I'm going to cover two major provisions that are affecting my clients directly. Related to this, I want you to first note, though, that there was a lot of press, a lot of coverage, if you will, and talk about the capital gain rate going up, the top tax rate going up, and a bunch of changes related to estate tax planning. Those are not involved with the HR 5376 that passed the House. It all got scrapped. The two major provisions that are affecting my clients is the SALT limitation being increased and the net investment income tax that has been expanded onto income that's never been subject to it, meaning active income that is from pass-through entities. So when we go into year end, what I'm indicating to my clients related to the SALT limitation, what is that? That's the state and local tax deduction. Currently, this is down at the individual level. It's if you itemize your deductions, which is on Schedule A, you only are able to deduct up to $10,000 of state and local taxes. That is state income taxes as well as real estate taxes, or if you don't have a state income tax, it could be state sales tax. Again, this is only if you itemize, which for many, they would be able to itemize if they didn't have this limitation of $10,000. So when you look at what passed the House, it is that you can deduct up to $80,000 and retroactive back to 1/1/21. Now, the problem with that is then, well, before year end, do you want to pay whatever it is that you're going to owe for state taxes? Do you want to pay all of your real estate taxes before year end? The quandary then is, well, if it doesn't pass this year, which it's not going to, then if it does pass next year, well, when will that be? And then will it be that it's retroactive to 1/1/21 still? However, the Senate has looked at HR 5376 as passed the House, and they have come back very recently with their draft of it, and it includes no provision to increase that SALT limitation. Therefore, it seems as though when you're now looking at the odds that it would be increased for 2021, it seems like there's less likelihood that that would come into play. But still, the quandary is that once we hit 2022, you won't be able to do anything related to this tax deduction for SALT in terms of increasing the amount that you could allocate to 2021 because it has to be paid in the calendar year of 2021 to deduct it in 2021. So many times when you're coming up on something where you don't know if it's going to go left or right, then it's typically best to just go straight ahead with what we do know. So what I'm telling my clients is that we should just follow the normal course of our planning, which is there wouldn't be a reason to stack up your state and local taxes and deduct them before year end because they're going to be limited to $10,000 under current law. My hunch, and that's all it is that if they do increase it, it won't be up to $80,000. It'll be to some dollar amount that's increased, meaning you would be able to deduct up to maybe $15,000 or $20,000 or $30,000 of state and local taxes. And it would be effective in 2022. And the reason I indicate, well, we just got to move forward and go straight is that I think there's more likelihood, again, my hunch, that this would go into play in 2022. Yes, tax laws have been retroactive. However, what would cause there to be issue is that tax season will have started and tax filings will have already started. And yes, you're right. The law can still change and things can still be retroactive, and we may see an increase to that. But the thing to note is that if there is an increase for 21, there would be an increase to 22 as well, because it's not just a one-year provision that we're talking about in terms of being able to deduct more state and local taxes. So with that being said, if I'm not having my clients worry about packing in and paying as much as they can before year end in state and local taxes, well then we're going to follow the normal course, which is we would pay, or clients would pay, what they would owe in 2022, not trying to, in essence, ensure that whatever is going to be due, they pay before year end, because they then would be able to get that extra punch in 2022. And at the end of 2022, they could then ensure that they've paid all state and local taxes before the end of the calendar year, which would bunch up the deductions in 2022. So we may not have the immediate satisfaction if they do in fact make the law retroactive in terms of getting the deduction. But for my clients, especially if they had it limitation up to $80,000 in state and local tax, all of my clients, even packing it in for the beginning of the year and the end of the year, would be able to get a full deduction pretty much for all of my clients. So all I can tell you is what I'm doing for my clients. Can't make a recommendation for you because I don't know your circumstances. Now, the other major provision that's affecting my clients is the net investment income tax. This is a 3.8% tax. It currently exists, and that tax applies towards or on interest and dividends and capital gains and passive income, to name the big ones. Now, until your income is over $250,000, then those things I just mentioned are not subject to the 3.8% tax. Now, when I say your income's over $250,000, it's collectively everything, not just one aspect of your income. All income over $250,000, then those, in essence, streams of income that are taxable are then subject to the 3.8% tax on the amounts that are overall above that. Now, that 3.8% tax, as it's written in the Build Back Better bill that's passed the House, H.R. 5376, is that it would now apply towards K-1 income that's active. So it wouldn't matter if you material participate, it wouldn't matter if it's non-passive. What would matter is that if it's on a flow-through K-1 from an S-corp or a partnership or a trust, basically now box 1, 2, or 3, which is ordinary income, real estate income, or other real estate income, the 3.8% net investment income tax is only going to apply under current law if those items are passive from a K-1 in box 1, 2, or 3. If this law becomes law, or I should say, if this bill becomes law, then box 1, 2, and 3, period, the end, would be eligible or subject to this 3.8% tax. Now, as it's written now in the bill, it would apply for overall income for those that have over $500,000 married filing jointly, and I believe it's $450,000 for single. So what'll be interesting is that, well, will the 3.8% tax go into play for interest, dividends, capital gains, and passive income still at $250,000? And then for the active income, will it go into play in essence on overall income that's over $500 for married and filing jointly, $400 for single? We'll see. The thing is that for year-end tax planning, we already went through the SALT, it does provide some different look at what kind of planning we're doing at year-end. Because in essence, if you do have income that's that high, your taxes are going to be higher by 3.8%. May not be enough to change what your year-end tax plans are. However, it's something to be aware of. I do find that extremely likely to occur. That has been something that has passed the House, as I indicated, and looks like it will definitely pass the Senate, especially based on the Senate's draft coming back, and they're going with that. So for year-end tax planning, there's lots to it. I've got a couple of seminars you can check out. I've got instant access. I've got some CPE. I'm going to put links to that in the body of this video. I got a monthly tax update next year that's eligible for the CPE. If I didn't mention already, I'm going to put a link to the American Institute of CPA's summary of the Build Back Better bill that has passed the House, because there are some other provisions in there related to Roth 401k conversions and green energy incentives and other tax credits, and some other provisions in there for taxes that are being applied towards those that are making millions and millions. So I'll let you look at those. But these are the two major things. And here's what I'm telling my clients. And typically with my clients, there's only been a handful that we have changed our normal course of year-end tax planning, where we're not doing any kind of prepayment of expenses, if you will, to reduce down this year, because those deductions will be more valuable next year. But these are clients that are well above the $500,000 mark. So be aware of those. Talk to your advisor about this. Fellow advisors, obviously taken into account with your year-end planning, which I'm sure you already are. All right. I think that covers at least where we are right now. Once we know that this has become law, I'll come out with another video and indicate what we are dealing with. So with that being said, I hope you're doing well. Happy holidays. Happy New Year to come, or if you listen to this right after Happy New Year, or the first Happy New Year to you. Hope you're doing well. All right, hey, thanks for tuning in. I'd love it if you'd subscribe, and then don't you ever forget, you've never met a CPA quite like me. All right, have a great one.